Let us now get into the different weighting methods, starting with price weighting. Now here, a very popular price weighted index is the Dow Jones Industrial Index, which has 30 stocks. So how would you go about it is you would add all of the prices and then you would divide it by the number of stocks. Now, there is something known as stock splits. We'll talk about that shortly and how that would make an impact on this divisor, but just ignore the splits for now. Let's keep it simple. Why are we summing these prices? Think of a price weighted index as an index which has one of each stock, right? So you're buying one of each stock. So the total value of the index is basically the average price. And how do you calculate the average price? You add all of the prices and you divide it by the number of stocks. So that is the average price and that is your starting index. Then let's say the prices change. So you calculate the new sum, right? Let's say the sum was 100 before, now it goes to 120. And the divisor stays the same unless there is any split, and we'll talk about that later. Assuming there is no split, so the divisor stays the same and the overall average price, which is the index, goes up, which means you make some return. Now this return is called your price return, right? This is called your price return, that because the prices went up, the average price has gone up and therefore you've made some money on it. There is also income or dividend, right? So whatever is the total dividend you earned divided by whatever is the total investment. Now what is the total investment is the sum of the prices. Since you're buying one of each, so your total investment is just add all the prices up. So that's your total investment. You will get your dividend yield or your dividend return. You take that return, you add it to your price return, right? You add it to your price return and what you get is your total return. And that is something you have to be able to calculate, right? So this is the main formula that you need to remember, that you calculate your price return based on the index beginning and ending value, and then the dividend return is total dividend divided by the sum of the prices at the beginning, because that's your original investment, and both those returns you add it together and you get the total return. Just to make sure you've understood this concept, please have a go at this question. Please pause the video and try to solve this. Right, so hopefully you were able to do it, that the beginning index value is the sum, which is 4 plus 6 plus 10, which is 20, divided by the number of stocks, which is 3. So your beginning index value is 6.67. Think of it like an average price, right? This is the average price of these stocks. And then the average price becomes 7.33. How? The total, which is 2 plus 6 plus 14 is 22, divided by 3 becomes 7.33. And how much is that in return terms? 7.33, which is the ending value minus the beginning value divided by the beginning value. And you get 9.89. Now that is just your price return, right? What is the income here? 1 plus 2, so total of 3. And your original investment is 20. Right, so if you bought one of each, that would be 20. So you make 15% on your dividend. You made 9.89 on your price, approximately 10. So 10 plus 15 is approximately 25. Now guys, coming to a little bit of a confusing area, stock split. See, first of all, let me just tell you what is a stock split. Companies consciously try to make their stock prices cheaper. So for example, Amazon was having a stock price of around $3,500, or Google was having a stock price of around $2,500. This is the post-COVID 2020 situation. But then they had a 10 for 1 stock split. So for example, if somebody has a 10 for 1 stock split, if you had one stock of Amazon and you had $3,500 worth of investment, suddenly you would have 10 shares in your account, right? But each share would be worth 350. So your value would have been the same, but the price per share goes down. Now, why they do it? So that it's cheaper or more affordable for everybody to buy the share, right? So that's the logic of a stock split. But how does that impact our price weighted index calculation? Because obviously, I mean, it's not like the share price is going down. It's not like Amazon crashed from 3,500 per share to 350 per share. The value of the index shouldn't change, right? The index value should not change. The only thing that will change is the divisor. Now, the question is, how do you calculate the divisor? So if you have, let's say, this is your ending value, which comes to 22 divided by 3, which was coming to 7.33, right? Assuming this 7.33 stays the same. The only thing that is changing is that stock C is having a 2-for-1 split, so its price will become half. If its price becomes half, this 22 changes to 7 plus 6 is 13 plus 2 is 15. So this changes to 15, right? So clearly 15 divided by 3 is not 7.33, but that 7.33 cannot change. That 15 obviously cannot change because that is the sum of these prices. So the only thing we can change is the divisor. So the divisor then becomes 15 divided by 2.5, I believe it's going to be. So that is your new divisor, which is 2.05. Now, just to make sure you've understood this point practically, think about Dow Jones. Now, Dow Jones, I told you, is a 30 stock index. And it had an original divisor of 30 because there's 30 stocks and we have the sum of all the prices of those 30. Now, over the years, it's a very, very old index. Over the years, many stock splits have happened in those prices. So the sum, what it was originally, is much lower now after adjusting for all the stock splits, right? So if the numerator keeps going down, but you don't want to change the value of the index every time there is a split. So the only way to preserve the value of the index is that the denominator must go down as well. If you will search online, what is the Dow Jones divisor now, having all these stock splits happened over the years, I think it's not even 1, right? It's not even 0.1. I think it's like something like 0.015 or something like that. Very, very small. So all these years, all those stock splits have been reducing the price. So here you saw it went from 22 to 15 because this 14 reduced by 7. And then we had to reduce the divisor from 3 to 2.5. Similarly, the reality is that Dow Jones, the divisor, has been going down and it is like less than 0.1 now. So this is the concept of your impact of stock split. Now coming to the second point over here, which is what are the pros and cons of the price weighted index. From a testability perspective, of course, the calculations are important, but this theoretical understanding is also very important, that what are the good parts of price weighted and what are the negative parts. So now the good part is that it's simple, right? But the bad part is that you're giving weights to securities based on price. I mean, why is C getting a much bigger weight? I mean, think about it, right? I mean, if your total investment is $22, 2 going in A, 6 going in B, 14 going in C, there's a lot more money going in C than A. And that doesn't really make sense. This is arbitrary, right? I mean, the weight you're giving to C is just based on because it has a higher price, but price doesn't necessarily mean it's a solid company, right? I mean, if Amazon can reduce its price from 3,500 to 350, right? Or even in this example, C reduced its price to 7, and then now it's getting a lesser weight than it was before just because it did a stock split. That doesn't really make any sense. So the problem with price weighted index is that it's not a very smart way of doing the weighting, because just because a stock has a high price does not necessarily means that it deserves to have a high weight. It's not necessary that its market capitalization is higher, because on its own price means nothing. You have to take the price and you have to multiply it by the number of shares. Then you find out, okay, what is it really worth? Is it a bigger company? For sure. And that is why, of course, market cap weighted index is very good, because it takes into account, and let me just show you. So going back to the high level slide over here, the market cap weighted, as you will see very soon when we get to that, the good thing about that is it gives a higher weight to those companies which not just have a higher price, but price multiplied by number of shares. And even if the share price does go down, but the number of shares goes up. So if Google or Apple or Amazon, the share price has come down and the number of shares for each one, there is now 10 times more. So the market cap doesn't change. And why is that really important is because when let's say you are an investment advisor and there's a client coming to you and saying, okay, please invest this 100 million for me, right? If the bigger companies are there, then you will be able to invest more in the bigger companies and you will be able to invest a lesser amount in a smaller company. Because if you try to invest too much money in a small company, it becomes really difficult because the shares are just not available. So that's why market cap is very good, because I mean, what's the whole point of this index? The whole point is not just to track the investment universe, but it should be an investable universe, right? I mean, if you're giving equal weighting to all, equal to a small and big company. But then when you go to invest the same equal amount in a big company, you will be able to invest it easily. But in a small company, it will be difficult because you're not going to be able to find the number of shares to buy. So that's why market cap is very good. But yeah, equal weighted is also a thing, and we're going to talk about that now, right? That what equal weighted basically says that you put the same amount of money or equal amount of money in all securities. Now, that might be a very good thing if your client is coming to you and saying, hey, I want to invest in these 500 stocks, but I don't want to put more money in the bigger one and less money in the smaller one. I want you to diversify my portfolio equally across all these securities. In that unique situation, yeah, this might be a good option. But otherwise, I mean, it doesn't really make that much of sense to put more money in the same amount of money in both bigger and smaller companies, right? But that's what the equal weighted index does. It puts equal amount of money in all the indexes. So let's say if you had 180,000 to invest and there's a stock A which is trading for 4, right? So you'll put more money in this. You'll put more money in this compared to a stock C which is trading at 10 because the price is so you'll buy more shares of this compared to the other one because you want to put equal amount of money in this, right? So you'll buy more shares of the cheaper one and less shares of the expensive one, so that the amount of money is equally spread across all of these. Now, as far as the exam is concerned, what do you need to know, right? Ignore this formula. I'll just explain it to you in a very logical way. All you have to do is you have to calculate the return, right? And you have to then take the average of that return. Very, very simple, straightforward stuff. Equal weighted, the calculation is very easy, right? Now, what does that mean? If you want to do it price wise and then income wise, you can do it like that. So let's say the price here is going from 4 to 2. So that's obviously minus 50% return. This is 0% return. It's not changing. And this is going up by 40%, right? So you calculate this return and you just take its average. So just add all of them and then divide that by 3. So minus 50 plus 0 plus 40, that's minus 10, and minus 10 divided by 3 will be minus 3.33. That's your price return. Very, very simple, straightforward. Just take their average and that's it. If you want to calculate the income return, very simple as well, right? All you have to do is take each of these and look at the return on the original investment. So obviously there's 0 income here. There is 1 over 6th here. There is 2 over 10 here. So you just add those up, divided by 3, and you will get your average return. And let me show you the solution as well. And then you can add your both price and you can add your price and your dividend, and then you'll get your total return. So the calculation for equal weighted is very, very simple. All you have to do is calculate the return for each, take its average, calculate the return for each, take its average, and that's it. Now, the important thing, what are the pros and cons of this? Again, pro is that it's simple. Now the con is that it requires frequent rebalancing, because if you're putting equal amount of money, let's say in Google, Microsoft, Amazon, and one of them goes up, right? Let's say Microsoft goes up, then you have to sell a little bit of Microsoft and you have to buy a little bit of Google and a little bit of Amazon. So it requires frequent rebalancing. That's the problem with equal weighted. Now coming to market cap. Now this is very good because from an investability perspective, you're giving more weight to a bigger company and less weight to a smaller company. And what is a bigger company? How do you calculate market cap? Well, it's very simple. You take the price per share multiplied by number of shares, right? And then whatever is the market cap of the security divided by the total market cap of all the constituents, that is how much weight a company gets. So if Netflix has a smaller market cap than Google, Amazon, Microsoft, well then Netflix gets a smaller weight, right? And how do you calculate the price return and the dividend income return? Well, price return is very simple. You take the total market cap current and the total market cap starting. So let's say if it was 1,000 to start with, became 1,200, right? And then whatever was your index to start with, let's say it was 100. So then you get your new index. Let's say that goes to 120, and then you can just calculate the return on that. In terms of dividend, of course, then you have to see, okay, how much money you have put in the beginning investment, right? In terms of the total market cap that you bought, which is number of shares multiplied by price of every share. You have to add it all up, right? And then you have to see what was the total dividend you earned on the entire investment and what was the dividend return percentage. So This is different than price weighted. Now let me just summarize things till now. Price weighted, what were we doing? We were saying that you sum all the prices, you divide by the divisor, right? And you get the index value, the starting index, the ending index, and you calculate the return. As far as the dividend is concerned, you took the total dividend and you divided by the sum, because you were buying one of each, and that's how you got the dividend return, and then you added and you got the total return for that. For equal, what did we say? We said for each stock, based on the change in price, you calculate the return, and based on the dividend that it has paid you compared to its own price, for each stock separately you calculate the return, and then you take the average of all of them. But here, that's not what we're saying. Here what we're saying is, number one, you take not just the price of each stock, you have to take the number of stocks of each stock and calculate the market cap. And then you calculate the total market cap of the entire market, all the stocks price into stocks, right? That's your base here. Then you do the same thing for the prices once they change, and that's how, and you take your starting index value and you calculate your ending index value and you get your price return. And as far as dividend return is concerned, you have to see it as a percentage of total market cap. So you'll take total dividend, which is dividend per share multiplied by number of shares, divided by total market cap, which is all stocks market cap put together, right? So this is how you calculate the dividend return. Just to make sure you have got this concept, what I want you to do is, number one, calculate the divisor, right? Which let me just help you out with the first part. Let's say the index is 1000, right? So you calculate the market cap, which is 500 stocks into 4 plus 100 stocks into 6 plus 100 stocks into 10, right? What is the divisor that gives you this value of 1000? Next, what I want you to do, assume that this index is at 1000. We want to find out where is it going, right? So what is the ending market cap and what was the beginning market cap? Beginning market cap is obviously given by this numerator over here, which is 500 into 4 plus 100 into 6 plus 100 into 10. So you calculate the ending using these prices and you tell me what is the ending index value. Then based on the beginning index value and ending index value, I want you to calculate the, ignore this for now. What I want you to calculate is calculate the final index value, calculate the price return. Now what is the price return? Price return is the return on the beginning index and the ending index, right? So beginning index being 1000, calculate the ending index by taking the beginning and multiplying it by ending market cap divided by beginning market cap. So you get the ending index, calculate the price return on that. But more importantly, what I want you to do is also take this dividend, multiply it with the number of shares, so calculate the total dividend and then divide that by the beginning market cap to find out what is the dividend yield, and then add that to the price return to get the total return. So this is what I really want you to be able to calculate, that price return, dividend return and total return. Pause the video, please calculate price return, dividend return and total return. Right, so hopefully you are able to first calculate the divisor. So you start with the beginning market cap and that comes to 3600, assuming the index is starting with 1000. So you calculate the divisor. That's the starting point. Now, next you have to calculate the ending index value. How do you do that? Well, you have to calculate the ending market cap, which is these prices multiplied by these shares. Divisor says the same, right? And you get 833. And you can calculate the price return based on that. Now, if you wanted to skip the whole divisor discussion, you could have directly calculated this as well. All you have to do is you take the ending market cap and divide it by the beginning market cap. So that is also something you can do, which is ending market cap is 3000, beginning market cap is 3600, right? And you can calculate that in terms of the price return, that if ending value is 3000, beginning value is 3600 divided by beginning value of 3600, you get the same price return. So that is also another simpler way of doing it if you just want to avoid that whole divisor calculation. Point number one. Point number two, the dividend return. Now here you take the total dividend, which is $1 on these 100 shares, $2 on these 100 shares, right? So you have to take it for all the shares and then divide that by the total investment. So that's the beginning market value, right? When you're investing in this, if you're buying all the shares at their price, this is the dividend you will earn on all the shares. So that is 8.3%. And then you add 8.3 to the negative price return that you have, because obviously the index is going down, and then you get your total return. So this is of course one of the major calculations here. Then what if it has a market float of 40%? Now see, you have to first understand the concept here, that what is a market float and why do we need to at times take that into account. Now see, sometimes what happens is that there are stocks which are closely held, right? So there might be a stock which is having let's say 100 shares, take the example of stock C, but 60 of those shares are closely held, right? Either because it's a government organization and the government is closely holding those shares, or it's a private business and the private family is holding those shares. So they're not available for investment. And the whole point of making an index is that, hey, we want to track an investable universe. And if those shares are closely held, well, they are not investable then, right? So there's no point tracking them. There's no point taking them into account. So if the floating in the market, the number of shares which are available in the market, which are floating in the market, is only 40%, well, all you have to do is just take this 100, cross it out and make it 40. That's it. Right? So that is how you calculate a market float adjusted market cap weighted index. Instead of 100, you take 40. That's it. Right, now the pros and cons of market capitalization weighted index. Of course, the advantage is very, very obvious, that you will track them in proportion to their value, which is a really, really important point, because that is how the investability goes, right? Because at the end of the day, you want your performance to be benchmarked to something which is practical in nature, and market cap, especially a float adjusted market cap, is very, very practical in nature. However, it is having something called a momentum bias, right? So let's say those stocks whose prices are going up for whatever reason, right? Markets are emotional in nature. People think, oh, Netflix is the new thing, streaming companies will keep growing, and the next thing you know, Netflix is coming in, Exxon is going out. So this is of course that is there in market cap weighted index, and it does have a tilt towards those companies whose prices are going up and their values are going up, their market cap is going up. Next is fundamental weighted index. So the good thing about this is that it keeps things real, right? Instead of taking the market price, what we would look at is, okay, what is the revenue of this company? Let's give a higher weight to the company that has a higher revenue or higher earning or higher dividend or higher cash flow or higher book value of equity, not market value. So this is also a very, very good way of doing it. And the good thing about this is it has a value tilt, right? It is inclined towards giving more weight to those companies which are good value for money. Now, here, if you look at the question, they've given the same amount of earning for all three of them, which just basically means that it's going to be an equal weighted index, right? If, of course, this was 40 and this was 10 and this was 60, then you would have to calculate the weighted average. But I'll just show you the calculation. It's very simple. It's just like a equal weighted, because you're taking an average here, you're giving them an equal weight. But if they had different weights, then you would then give them different weights accordingly, both to their price return and to their earning return, right? So you calculate the price return separately, you can calculate the earning return separately, and then you can of course give them weights according to whatever is the criteria. It could be earning, it could be sales, it could be cash flow, book value, dividend yield, anything, whatever is the fundamental criteria we are taking, right? And then you take a weighted average and you get your return. And of course, the good thing here is that it has a value tilt. Right, so let's have a look at the summary of this. Now you can see the total return is being overestimated by the price. Why? Let's have a look at what's going on. Obviously, A is going down, right? B is the same, and C is going up. Now, because C has a higher price of 10 compared to 4 and 6. So this price weighted is giving a much higher weight to stock C, and which is going up. So that's why its total return is being overstated compared to the others. And why is market cap understating the return compared to your equal and fundamental? Well, obviously because market cap is giving a higher weight to the stock which is going down. And why is it giving a higher weight to the stock which is going down? Because the market cap is bigger, right? What is 10 into 100,000, right? What is 6 into 100? 600. And what is 4 into 500? 2,000. So clearly the market cap for A is more, and therefore it is getting a higher weight and it's going down. So that's why the market cap is little bit lower in terms of total return compared to equal and fundamental. And why is fundamental the same as equal? It's just a coincidence because we have given them all equal weighting because their earnings were all the same. If it was different, then this would have been different as well, depending on if we were giving a higher weight to the one that was doing well or to the one that was not doing so well. So accordingly the result would vary. And what are the pros and cons? So here's a summary. Price weighted, the con is that those weights don't mean anything. They're based on price, and the price doesn't really mean anything. However, it's simple. Even equal is simple, but then it requires frequent rebalancing. Now the good thing about market cap weighted, very, very important, is that they are going to give weights based on the size of their companies. That's really important because in reality, practically, that's what matters, right? In terms of investability. That's really good. But it does have a momentum bias that it is influenced by securities whose prices get overpriced because, markets are emotional. And we'll talk about that when we get to market efficiency and what are the biases in the market and behavioral biases in individuals and how that impacts all this euphoria that happens at times. But anyways, more on that later. Coming back to our indexes and to the fundamental index, the good thing here is that it gives a higher weight to the good ones, the value for money one, so it has a value tilt. That's good, but it doesn't consider the market value. That's bad. And it also requires frequent rebalancing, not as much as your equal. So look, the word here is frequent rebalance for equal and just requires rebalancing for fundamental. So as far as rebalancing is concerned, the most frequent rebalancing required is for equal. All right, so that was your major crux of this reading. Let's take a break here. We'll come back and then we'll talk a little bit more about rebalancing and reconstitution.